It starts with a phone call. It is not the kind of phone call you ever want to receive, but right now, it is ringing in boardrooms across Toronto and Vancouver. The call comes from the risk management department of a major Canadian bank, the Tower, the Green Machine, or the Red Lion. The voice on the other end is polite, corporate, and absolutely ruthless. "We have reviewed your credit facility," the banker says. "We are reducing your borrowing base by 50%, effective immediately. We need you to pay down the line within 30 days. The fund manager on the other end of the line breaks into a cold sweat. "But our money is lent out in mortgages. It's in construction projects. We can't liquidate that fast. If we sell now, we take a massive loss." The banker replies, "That is not our problem. Read your loan covenants. Mums, you are in breach. Pay us or we seize the portfolio." This conversation is the invisible trigger for the crisis that is about to lock up your life savings. Welcome back to Canada Property Watch. We told you the bankers were getting fired. We told you the luxury homes were being sold in a panic. Now we are telling you why. The big banks are de-risking. They are aggressively pulling the plug on the shadow banking system. And if you have money in a private mortgage fund, a mortgage investment corporation, MIC, or a high-yield trust, you are about to become collateral damage in a war between the giants. In this deep dive investigation, we are connecting the dots between the big bank layoffs and the private fund freeze. We will explain how the credit line connects the skyscrapers of Bay Street to the strip mall lenders. And we will expose the margin call that is forcing funds to freeze withdrawals today. And we will tell you why your safe 10% return is about to disappear into a legal black hole. Your money isn't just trapped by bad loans. It is trapped because the big banks decided to save themselves first. To understand why this is happening, you have to understand the architecture of the Canadian financial system. We have two systems running in parallel. First, you have the Tier 1 system. These are the big five banks: RBC, TD, Scotiabank, BMO, CIBC. They are regulated, insured, and too big to fail. They have access to the Bank of Canada's liquidity window. If they run out of money, the government prints more. Then you have the shadow banking system. This includes MICs, private funds, and alternative lenders. They lend to the people the banks reject: the self-employed, the real estate flippers, the bad credit borrowers. They pay investors, people like you, a high yield, maybe 8% to 12%, to fund these loans. But here's the secret that the brochure didn't tell you. The shadow banks are addicted to the big banks' money. Most private funds do not just lend out investor capital. They use leverage. Let's say you put $100 into a fund. The fund manager takes your $100, turns around to TD or RBC, and borrows another $50 at a low rate, say prime plus 1%. Now they have $150 to lend out. They lend it at 12%. They pay the bank 6%. The difference amplifies your return. Leverage makes the yield juicy. It makes the fund look like a genius in a bull market. But leverage is a double-edged sword, and right now, the sword is swinging back. The loan from the big bank to the shadow bank is a demand loan. That means the bank can ask for it back at any time, for any reason. They don't need to wait for the mortgages to mature. They can just say, "Give us our money." And that is exactly what is happening in February 2026. Why now? Why are the banks pulling the plug today? Because of what we discussed in our last two videos, the asset values are collapsing. The big banks have armies of analysts. They see the data before you do. They see that the luxury home in Oakville that was worth $2.5 million is now selling for $1.8 million. They see that the pre-construction condo projects are stalling. They look at the shadow bank's portfolio and they say, "Wait a minute, you lent money against these assets? These assets are toxic. Your collateral is shrinking." When the value of the collateral drops, the loan-to-value, LTV ratio, spikes. The bank's contract says the shadow bank must maintain a certain LTV. When prices crash, that covenant is breached. The big bank issues a margin call. This is the moment the shadow bank run begins. The shadow bank has to come up with $50 million cash to pay back the big bank today. Where do they get the cash? They can't sell the mortgages fast enough. So they look at the cash reserve. The bucket of money kept for your withdrawals. They take that money and they send it to the big bank. Why? Because the big bank has a general security agreement. They are the senior creditor. They get paid first. You, the retail investor, are the unsecured or subordinated creditor. You are last in line. So, when you log into your account to withdraw your $50,000 for your retirement trip, the button is grayed out. The fund sends you an email. Due to extraordinary market conditions, we are suspending redemptions. Translation: the big bank took all the liquidity. There is nothing left for you. This is not a theory. This is the mechanics of a systemic liquidity crisis. We need to dive deeper into the zombie portfolio that is created by this dynamic. When a fund freezes, it enters a state of suspended animation. The manager stops trying to grow. They switch to survival mode. Their only goal is to liquidate assets to satisfy the big bank and eventually open the gates for investors. But how do they liquidate in a crashing market? This brings us to the power of sale nightmare. The shadow bank holds hundreds of mortgages. Many of borrowers have stopped paying because of the payment shock. Rates went from 4% to 12% for them. The shadow bank seizes the properties. Now, the fund owns 50 townhouses in the suburbs, 10 half-built condos in the city, and a plot of raw land in the middle of nowhere. To get cash, they have to sell these. But who is buying? As we showed you, the buyers are gone. If the fund dumps these properties on the market, they get 60 cents on the dollar. If they take a 40% loss on the portfolio, the unit value of your investment drops from $10 to $6. They don't want to show you that loss. They don't want to admit that the money is gone. So, they don't sell. They hold. They extend and pretend. They keep the properties on the books at the old inflated values. They tell you the NAV, net asset value, is still $10. But it's a lie. It's a mark-to-model fantasy. The real market value is vastly lower. By freezing withdrawals, they prevent you from realizing the loss. They lock you into a burning building and tell you it's just a temporary heating issue. And here is the terrifying part about second mortgages. Many of these funds chased yield by lending in the second position. That means there is a first mortgage held by a big bank ahead of them. Borrower owes $800,000 to RBC first, owes $100,000 to Shadow Fund second. House value drops to $800,000. Borrower defaults. RBC sells the house for $800,000. RBC takes all the money. The Shadow Fund gets zero. When you invest in a second mortgage fund, you are standing on a trapdoor. In a bull market, the floor is solid. In a bear market, the lever is pulled, and you fall into the abyss. The big banks know this. That creates the contagion. RBC knows that if they foreclose on the first mortgage, they wipe out the shadow fund behind them. But RBC also lends to the shadow fund. It is an incestuous loop of destruction. The big banks are effectively cannibalizing their own clients to protect their balance sheets. This brings us to the human cost of this freeze. We are receiving emails daily at Canada Property Watch from seniors, from retirees, from young couples saving for a home. I put my inheritance in this MIC because my advisor said it was as safe as a GIC but with better yield. I need this money for my daughter's tuition. I use the monthly dividend to pay my own rent. Now, the dividend has stopped. The principal is frozen. This is not just a wealth effect issue. This is a livelihood issue. When the shadow banks freeze, the income stream for thousands of Canadians dries up instantly. It forces those investors to cut spending. They stop going to restaurants. They cancel renovations. They default on their own car loans. This is how a financial crisis morphs into an economic depression. The velocity of money stops. And let's talk about the borrowers, the people who owe money to the shadow banks. Usually, private mortgages are one-year terms. Every year you renew. But now, the shadow bank is frozen. They are under a margin call from the big bank. They cannot renew the loan. They need the cash. So they send a letter to the borrower. We are not renewing. Pay us back in full in 30 days. The borrower panics. They go to another private lender. But that lender is frozen too. They go to the big bank. The big bank laughs and says, "You don't qualify." The borrower has nowhere to go. The shadow bank initiates foreclosure. This floods the market with distressed inventory. More inventory to lower prices, to more margin calls from big banks, to more freezes. It is a doom loop, a self-reinforcing spiral of liquidation. We also need to address the regulatory blind spot. Why did the regulators allow this? The shadow banking sector is lightly regulated compared to the big banks. It falls under provincial securities commissions, not the federal OSFI, Office of the Superintendent of Financial Institutions. For years, regulators looked the other way. They liked the shadow banks because they kept the housing market moving. They provided the credit that the big banks wouldn't. Now, the regulators are silent. They know they let a monster grow in the backyard. There is no CDIC insurance here. If a MIC goes bust, the government does not write you a check. You are on your own. So, is your money gone forever? Not necessarily, but it is definitely not $10 a share. Best case scenario, the fund gradually liquidates over 2 to 3 years. You get your money back in drips and drabs. Maybe you get 80 cents on the dollar. Worst case scenario, the big bank calls the entire loan. The fund can't pay. The big bank forces the fund into receivership. The lawyers get involved. The assets are fire sold. The first mortgage holders take everything. The second mortgage holders, the fund, get zero. You get zero. This is the capital stack reality check. The taxman, the big bank, the receiver/lawyers, the fund manager, fees. You are at the bottom of the food chain. When the carcass is picked clean, well, you get the bones. This shadow bank run is the final chapter of the easy money era. For 10 years, we believed that risk didn't exist. We believed that 10% yield was normal. We forgot the most basic rule of finance. Return is the price of risk. If you were getting 10% when the bank paid 2%, you were taking 8% worth of risk. That risk was invisible. Now it is visible. So, what should you do if you are caught in this trap? First, get in the queue. Submit your redemption request immediately. Even if they are frozen, you want to be on the list. Second, read the financials. Don't just read the marketing email. Ask for the audited financial statements. Look at the loan loss provisions. Look at the real estate owned, REO line. That tells you how many houses they have seized. Third, stop the drip. Now, if you are reinvesting your dividends, DRIP, turn it off immediately. Take whatever cash distributions you can get. Fourth, prepare for a write-down. Mentally accept that the money is not fully there. Adjust your retirement plan. If you count on that money to survive next month, you need a plan B today. And if you are watching this and thinking, "I'm safe, I only bank with TD," don't get too comfortable. The shadow banking collapse affects you too. When the shadow banks stop lending, the construction industry stops. Small developers go bust. Contractors get laid off. The economy slows down. And when those thousands of foreclosed homes hit the market, they drag down the value of your home. Even if you have a solid mortgage, real estate is an ecosystem. When the bottom feeders die, the whole pond gets sick. This is why the big banks are terrified. They are cutting the lines to save themselves, but they know that by killing the shadow banks, they are poisoning the water they swim in. They are choosing the lesser of two evils. They would rather kill the MICs than let the rot spread to their own balance sheets. The credit crunch is here. It started with the bankers getting fired. It moved to the luxury homes getting sold. Now, it has reached the savings of the average investor. The walls are closing in. We are watching the great deleveraging of the Canadian economy. It is painful, it is ugly, and it is necessary. The bubble was fueled by shadow money. Now the shadows are fading, and all that is left is the debt. Subscribe to Canada Property Watch. We will keep you updated on which funds are freezing, which are liquidating, and where the next domino will fall. Protect your cash. Stay liquid. And remember, if you can't touch it, you don't own it.